Welcome to America's Heroes Group.
Welcome back to America's Heroes Group. This time we're doing community outreach with our partner, Katz, Milanec. It's Saturday, August 12th, 2023. Our host is Cliff Kelley. I'm Sean Clement, the co-host, Army National Guard veteran. Our executive producer is Glenda Smith, and our digital media producer is Ivan Ortega, Scouts Arnold Productions. And of course, we have with us David Milanec. He is a CPA and president and founder of Katz Milanec Incorporated. That is a accounting firm that helps people with taxes. And he's a military family member. We're going to talk about taxes again, tax issues and tax questions with an expert. How you doing, David?
I'm doing great. How are you today?
Pretty good, pretty good. So it's August now. We're getting ready get to the last quarter of the year, and we have a lot of people getting ready to think about, paying taxes because the year is wrapping up. And we're also getting ready to think about, if businesses are trying to get their house in order, financial house in order, what do they need to know as far as some of the tax strategies that you employ to help people, small businesses in particular?
Well, so now is a really good time for most businesses to kind of do an assessment of where they are in the grand scheme of things. Like, what is my profit and loss showing me? What is how am I doing compared to last year? And it's a great time from a tax perspective. What we want to be doing right now is making sure that everything you need to is paid in, but also make sure that that's the absolute minimum that's going to need to be paid in by planning out what we're going to do for the rest of the year to minimize that tax liability and maximize what you keep in your pocket. So I can give you an example of this. I have a pharmacist, actually, who does some consulting on the side. So we set up a business for him. And this business, he does consulting work, but it's basically a break-even business. And because of some tax strategies we're able to employ, we end up saving him on average about $10,000 a year through doing things like leasing a home office to his business and leasing his vehicle to his business and creating a payroll for him and having tax withholdings on that. So there's a few strategies that we've employed, and the difference is that he used to have balance dues close to $10,000, and now he's getting refunds of about $2,000 or $3,000 every year.
Wow. Now during the pandemic, there was a lot of stimulus money that was put out to help people with employees, help businesses with employees, to help them keep employees on the books and keep them employed, essentially. Are those benefits still being doled out? I'm seeing advertisements for people that are still trying to advertise for services around this. What's going on with that area? Okay,
so if you remember the original CARES Act back in February or March of 2020, that introduced a tax credit called the Employee Retention Credit, okay?
Mm-hmm.
At the time, the Employee Retention Credit was very hard to qualify for, very unattainable, and didn't really have all that much in the way of impact that it would have. Much like when the Biden administration came in and they changed the rules on the PPP,
mm-hmm.
they also came in and changed the rules on the Employee Retention Credit and basically supercharged it.
Mm.
So if you paid a payroll at that time and you had employees and your business was affected at all by COVID. Now this could be as something as simple as, like, for a truck driver, you missed a shipment because something to do with COVID. If you're a therapist, someone canceled an appointment because of COVID. These are partial losses of business, right?
What about say you own a restaurant and even though you stayed open because you're just doing window-only service, but your traffic dropped off 20%?
Exactly,
okay.
100%. It's a full or partial suspension of operations, which almost every business qualifies as a full or partial suspension of operations. You also had to be under a government order. but all of Indiana, Illinois, Ohio, Wisconsin, all of the surrounding states around us, they were all under government orders during that time frame. So if you were under these government orders, you can claim up to $26,000 per employee. Now, the time frame for that is starting to run out, but basically what you have to do it is you have to go back and amend your payroll tax returns. So if you didn't have payroll tax returns, that's a clear sign right there that you can't get it. And by the way, there are fraudsters out there that will tell you that if you paid people on a 1099, you will qualify for ERC. You hang up on them because they are trying to get your information, and they are part of the reason that the IRS put the employee retention credit on the Dirty Dozen tax scams. But if you legitimately paid employees and you legitimately had paid into the taxes, you can claim and you qualify, and we can do the assessment of whether or not you qualify. You can claim this credit, and you can get up to $26,000 per employee, which is a huge boon for a lot of small businesses out here. If you think about it, if somebody employed 10 employees and maxed out their credits and they're eligible, they could get $260,000 out of this. It's huge. So if you're a business in that situation, you haven't claimed the employee retention credit yet because you're just not sure about it, give us a call, 708-914-8220. Again, 708-914-8220. We can give you a free assessment on that to see whether you qualify, and then we can tell you what we can do for you as a result.
And to reiterate, so if you hired a landscaper to cut your grass and because you're a property owner, that doesn't count. And then you couldn't show up.
Yeah, no, because that would be somebody you would pay on a 1099, or you wouldn't even necessarily file a tax form at all, depending on how you do things.
So what are some of the things, talking about property, what are some of the things that property owners can do, particularly landlords? Because it seems like with the new tax codes that are out now, it's a little bit harder for someone who's, say, a landlord or who owns maybe just a 2-flat, or just because in Chicago, in the Midwest, which is different from a lot of parts of the country, we have 2 flats, 3 flats, 4-unit buildings that are common everywhere. And there are family-owned businesses, technically, that rent space out. They may live in the space as well, but it's getting harder for them to. It was after the tax changes around, was it 2016 or something like that, where they changed the rules where it was harder for people to put them on to itemize those deductions for having real estate. What are some of the things? What's going on with that? Tell us about that.
So it's become a lot harder to what you're referring to is the Tax Cuts and Jobs Act. And what they did with the Tax Cuts and Jobs Act, one of the big things they did was they basically eliminated Schedule A from the tax code. I mean, they didn't really, but you have to have a large amount of charitable deductions or a large amount of mortgage interest now to qualify for an itemized deduction. And actually, what's funny is you kind of mentioned one of the ways that I use to kind of get around that in terms of still getting the tax benefit for my taxpayers. If you have a business, or if you are in a situation where, like you said, you have a 2-flat, a 3-flat. I've even got a client who has a 6-unit building. Basically, you obviously have to claim your rental income, but you can put all of this on your Schedule E in proportion to the amount of the property that is being used for rental. So, for example, with a 2-flat, it would be 50% because half of the space is a rental, half of the space you're living in it. If it was a 3-flat, it'd be 67% because, 2 of the 3 units are rented and you're living in the third space. One of the actual really big benefits of that type of situation that most people don't know about is that on a property where you are living in the property and renting it out, you can actually claim unlimited losses. Now, you don't want to get too crazy with it because if you start claiming $40,000, $50,000 losses, you're going to get audited. But if you legitimately spent that money, there's no reason not to claim it. and it's a way you don't necessarily have to be a real estate professional, but you can get an unlimited deduction on a property. And you can, not only do you get your mortgage interest, your property taxes, which are the two big things that go on Schedule A, you also get depreciation on the building for the percentage of use. You also get, if you have like a homeowners association, you can deduct homeowners association dues. It's the only place you can deduct homeowners association dues on tax return, by the way. You can deduct, like, if you have lawn maintenance, you can deduct your utilities, your homeowner's insurance. You can deduct all of that stuff in proportion to the amount that you rent out the property. And you can deduct it in full as the proportion of the amount you rent out the property. So, like, if it's a 4-unit, you can deduct 75% of whatever you pay in utilities, for example.
That includes advertising, all those different expenses. I mean, everything related to the portion of what's being rented out of your building or your real estate. Do they have to declare themselves as a business, though? Do they have to? Because some people have the idea, and I've heard this from many times from different people. They think they have to be like an LLC or they have to be a sole proprietor in order to claim these real estate deductions.
Well, I mean, all a sole proprietor is just a person who is conducting a business. So technically, if you have a 4-unit and you live in one of the units, you're technically a sole proprietor. I typically recommend to people when they're talking about any sort of business venture that you want to have an entity in place, and that even goes for like owning property and everything like that as well, because all having an entity in place does is protect you from legal liability. So it's very important to have that. And owning property, I wouldn't necessarily recommend getting an S corporation election, but when you're doing any type of business that has to do with, like, actually, like, if you're doing something in the gig economy, or if you're a construction contractor or a doctor or anything like that, and you're not getting paid on a W-2, you're getting 1099, you want to have a corporation in place, and you want to elect to be taxed as a small business corporation, because that's going to give you the least amount of tax that you're going to possibly get.
Now, you mentioned one thing about the some of the benefits for businesses since the pandemic or during the pandemic. So what about people that don't have employees, but they did suffer revenue loss? They're sole proprietors, perhaps, that lost revenue during the pandemic. Were there any tax credits or benefits for those people?
There was a sick pay benefit that you can try to go back and claim. It's a little bit difficult, but you can potentially get some pretty large refunds from that. We know how to navigate it. So if that's something like you did your taxes and you owed money and you were a small business out there and it was during 2020 and 2021, we could potentially look at that and get your refund. If you have concern about those years, if you wanted to give us a call, 708-914-8220, we could definitely look at that for you.
And then you mentioned also too about triggers for audits. What are some of them? What would you say are the top 5, if we can go that long, 5 things that people need to be careful about that might trigger an audit?
Things that could trigger an audit.
What does the IRS looking for? What's on their radar as far as audit goes?
Definitely taking a large business loss on a Schedule C is going to raise some eyebrows with the IRS. Another big one would be if someone has high medical expenses or something of that nature. Now, there are some times where that's 100% legitimate, and I have deducted $60,000 of medical expenses on somebody's tax return before, because they legitimately paid $60,000 for the treatment and care of their loved one during that year. So legitimate at that point to deduct the $60,000. But if you're putting high medical deductions, and especially if that's in combination with not so high income, like for example, if you put down $20,000 of medical deductions and you only made $50,000, you can pretty well expect that you're going to get audited. Rental losses in excess of $25,000. At that point, in most cases, the IRS is going to expect you to be a real estate professional and is going to therefore, in lots of cases, want you to prove that you are a real estate professional. So if you're taking a real estate deduction in excess of $25,000, you can pretty well expect to be audited. Other things, large losses on properties. I actually had a case where I had someone who took a $90,000 loss on a property because they did a deed in lieu of foreclosure, and technically under the code that was a sale of the property. But they didn't receive any funds for it. Well, they had the way it worked is they had paid in about they had a loan of $125,000. So after doing a few calculations, we basically determined that they had a $95,000 loss and created a net operating loss, which carried back to the prior year. That ended up getting kicked into audit, and the result was that we ended up getting the client $30,000 back between those 2 years.
Wow.
Because they were owed it, because under the code, everything that we said was correct. Those are things that basically big losses is what's gonna trigger audits in most cases.
Now, in real estate, because I'm not sure if this is a myth or not, but can people deduct vacant rental units as a loss or any kind of deduction?
As long as you're holding the property out for rent. If you acquire a property and you're trying to improve that property to put it on the market, that property is not yet held out for rent. But if you are actively trying to rent the property and you just don't acquire a tenant, you're absolutely allowed to claim that as a zero income rental property that you put expenses into, because you legitimately put expenses into it and you were attempting to hold it out for rent. The key is, though, that you're actually making the effort to rent the property, because if you're not making an effort to rent the property, then it's just an investment property that you're holding for sale. And that's what the IRS is going to argue, and there's not really a way to argue against that.
So to be clear, so the expenses that are associated with trying to advertise, market, actively get a tenant, that you can deduct, but just having a vacant unit and you're not doing any advertising, just sitting there for, and you're missing $2,000 a month in rent, the $2,000 a month in rent you can't deduct.
No. That the way the IRS looks at that is you're not claiming the $2,000 a month in rent, but you're also not able to claim any expenses. It's kind of a wash. Mm-hmm. You don't get the benefit of the $2,000 a month, but you're also not technically losing any money, if that makes sense, because you're just not gaining money.
Right. So you can't deduct money you never really collected.
Right. Exactly. But if you have expenses on those properties,
right? If you have expenses and you spend money trying to do something about it, then that's another story, because there are legitimate receipts that you can show that you actually spent money on, whether it's ads in a newspaper or a television spot, a radio ad, or signs up, legal fees, whatever it might be,
Or you have utilities, you have insurance. There's still expenses on a property if you're not renting it. Mm-hmm. You can still claim those expenses as long as you're attempting to rent it.
Mm-hmm. I think we just debunked one of the myths out there on social media, because there's a lot of stuff out there they're trying to tell people for different reasons. And a lot of these guys, I don't believe, are even CPAs. They're not even tax professionals. They're just, I don't know what their game is.
Yeah, there's a lot of tax advice out there, but really you need to run it by a professional. That's a key, because like another thing, I could give you an example of. A lot of people come to me about retirement accounts. I actually was able to get somebody, they had taken 3 large retirement distributions over the course of 3 years, total of $500,000.
Wow.
They got hit with a 10% penalty for that, but they met the requirements under one of the exemptions under Section 72 of the Internal Revenue Code, that they actually didn't owe that penalty. So I was able to get that person a $50,000 refund by amending those 3 years.
Wow. And briefly, kind of go in the 72T, 72Q rules. What are those?
It's one of the 72T exemptions. Specifically, that one was the person was over age 55 and had separated from service after age 55. And that actually means that you don't have to pay the 10% penalty. That's one of the qualifiers.
But make sure that's a very complicated strategy. Make sure you talk to a tax professional like Katz Milanec. What's your number one more time, and where do you operate out of? All over the country, or just Illinois, Wisconsin, or?
We can do taxes in all 50 states, including all the 43 that actually have tax returns. Our number is 708-914-8220. Again, that's 708-914-8220. Also, feel free to visit our website, katzmilanec.com. We have a contact form on there. You can contact us and schedule an appointment. And, we're here. We're happy to help.
Now, one thing, we talked about this before, but I think it's something important to go back to, because people have a lot of questions on this. We get a lot of this stuff on social media and questions that come into from our audience. People are very confused about S corps and when they become an S corp, when they become an LLC, the difference between an LLC and an S corp. How that works between when you set up your business versus when you're doing your taxes. Because people think that when I set up my business as an S corp, that's what the attorney told me, but their taxes are not being done that way. They're being done in a totally different manner.
Okay, let me give you this. I'm going to give you it as simple as I possibly can. So legally, you have LLCs and corporations. Okay, LLC is a type of entity. Corporation is a type of entity. They're types of legal entities. For tax purposes, LLCs are what's called disregarded entities. It means whatever the owner of the LLC is taxed as, that's what the LLC is taxed as. So if the owner is a single member, it's taxed as a sole proprietorship. If it's 2 people, it's taxed as a partnership. Now, you can elect to be taxed as a C corporation as an LLC. You can also elect to be taxed as an S corporation. If you set up a corporation, you can elect to be taxed as an S corporation, but by default, you will be taxed as a C corporation. So that's kind of the easiest way I can break it down. Now, when should you do that? When should you elect to be taxed as an S corporation? I'm going to say the easiest way to say this is anytime you are doing an activity that earns you income. So what I mean by that is, like, if you are renting out property, you're technically not doing any activity to earn that rent, right? You just own the property, and that person pays you rent as a result of it, right? Mm-hmm. So, but if you're a doctor, for example, you're providing services as a doctor to earn income, correct? Mm-hmm. So if you don't make that election to be taxed as an S corporation, you're either going to be hit with self-employment tax or corporate tax, depending on how you set up your entity structure. And if you do make that S corporation election, you don't get the self-employment tax, you don't get the corporate level tax. The only type of tax you have to pay is income tax, which makes it the lowest possible tax bill. Mm.
So it's really important to understand what your entity is legally, but how you do your taxes is something separate. It's not necessarily tied directly to LLCs. LLCs could be S corps, taxed as S corps, could be taxed as C corps, could be taxed as sole proprietors or individuals. Did I say that right?
Yeah, LLCs can be taxed as basically anything but a trust.
Okay, but if you are a C corporation and that's how you operate, you're kind of limited. What it sounds like.
you have a C corporation or an S corporation. So if you set up as a corporation, you have 2 options. If you set up as an LLC, you have 4 options. But really, the best option either way is going to be an S corporation, unless you're in a limited field of a limited set of fields where you don't collect income for providing services or selling goods. Things like rentals and things of that nature.
Wow. We have about 2 minutes left. Now, there are certain tax benefits that are sunsetting because of the way the tax code was written. Some of the things that came out in 2016 are, I guess, some of the exemptions, some of the I think the tax brackets. Tell us about that. What should people expect in 2024 when they're doing their taxes for 2023? As far as some of the tax sunsets that are happening right now, some of those tax credits that we were given a few years back.
Well, I think most of those have already expired.
Okay.
Yeah, pretty much. I mean, there's a couple of step-ups that I'm aware of. I know that the standard deduction is increasing. The thresholds for each tax bracket will be increasing for 2024. The tax brackets themselves will stay the same. Let's see.
So if the thresholds increase, that'll help people, right? Because that means you have.
Well, yeah, obviously, the more those so like for example, the standard deduction is going up to I think $13,850.
Okay.
That means the first $13,850 you make, you're not taxed on.
Great.
And that holds true whether you're you, me, or Elon Musk.
That is great.
So
I can take that.
The first $13,850 you're not taxed on. The next $10,000 or so, or $20,000 if you're married filing joint, is taxed at 10%, and then the next amount is taxed at 12%. The next amount's taxed at 22%, then 24%, then 32%, then 35%, and then when you get up to like $600,000, it's taxed at 37%.
Words to live by, people that things we need to know, people, for next year and this year too. Thank you for your time, David. You always give us great information. And once again, what's your number?
708-914-8220. Again, 708-914-8220.
That's David Milanec. He's the CPA and president and founder of Katz Milanec Incorporated and a family member of a military veteran. Thanks for your time.
Thank you, Sean. Always a pleasure.
This is America's Heroes Group. We'll be right back.